MMT isn't just saying to tax if there's inflation after the fact, but to think before you spend how it's going to affect different sectors and different aspects of the economy. I would rather see the Fed folded into the Treasury. It's just a spreadsheet with the accounting of the spending of the government. So just fold them in and get rid of the MPC in England and the FOMC in the United States and replace them with real resource economists, educated people on real resources in different sectors of the economy and the real economy. Get rid of bonds, merge the Fed, and get some real economists in there that actually do something that helps with inflation and understanding the real economy.
This is the MMT Podcast with Patricia and Christian Riley. Hi, I'm Christian Riley and welcome to the Modern Monetary Theory Podcast. You can find us on Twitter at MMT Podcast, and you can support the show by going to patreon.com/MMT Podcast. If this is your first time hearing about MMT, you might want to listen to our first 3 episodes for an introduction, which I've linked to in the show notes, along with some other things that relate to this particular episode. And as ever, I've linked to where you can support this podcast financially via patreon.com/MMT Podcast. Support starts at $1 a month or £1 a month or whatever the equivalent is wherever you live. And no matter what level of support you give, you get early access to all of our episodes and patron-only episodes where you can ask me and Patricia MMT questions. We're 100% listener funded. Your financial support really helps keep the show going, and your support in other ways, whether it's by recommending us to other people or just by listening and spreading the word about this stuff, really helps too. A big thank you to all of our supporters so far, and thanks as ever for the time you put into understanding MMT. Let's dive in. Welcome one and all to the MMT Podcast. I'm Christian Riley.
And I'm Patricia Pino.
And joining us today, we have author and geographer Clint Ballinger. How are you, Clint?
Doing good. Thank you, Christian.
So let's start with your background and how you came to MMT. Can you tell us about that?
So basically when I was a teenager and just reading the local paper in Dallas, you always saw the headlines, the fear-mongering about debts and deficits. And I started looking into it, and it just seemed like something didn't add up, but I couldn't put my finger on what. I've always been interested in kind of economic aspects of things and later focused on economic geography. I started reading, finding what I could. I didn't run across MMT at an early date, unfortunately. So I ended up reading Irving Fisher, which is kind of some more origins about the worry about credit money. And then later ran across Steve Keen's work. So I was really focused on the banking side, which also makes sense after 2007, of course. Eventually, I ran across an article by John Harvey in Forbes, his Social Security article. In that article, I could tell he didn't specifically mention MMT or vertical money, state money, but I could tell he was basically, in a way, talking about that, and I knew I was missing something, so I kind of researched into it a little more. And then I did finally run into some MMT stuff and just kept on reading, and Mosler and Mitchell and Ray and whatnot, and eventually came to understand the interplay between bank money and state money, and that's kind of what led ultimately to this book, that aspect of MMT.
I wanted to ask you, what does an economic geographer do?
Well, I studied in the human geography department, but economic geography, there's a wide range of things, but basically it's the spatial distribution of development, or that's possibly one definition. So trying to understand why different parts of the world are more and less developed. And I was really interested in taking a global approach. And I also looked at economics departments, and they were so horribly mainstream. Even before I'd really gotten in MMT, I could see that the type of economics they were doing wasn't very useful. So I purposely wanted to be in a geography department. Yeah, and the good thing about that is it led me to a lot of institutional and historical focused economics and non-equilibrium and a lot of stuff that goes right along with post-Keynesianism.
One of the many things in your book, 1,000 Castaways, one of the things that it does really well is that it describes that interplay between vertical and horizontal transactions in a typical banking system. Could you lay that out for us?
I guess the simplest explanation is just, as I mentioned in the book, a lot of the public and even, as we've seen, unfortunately, economists don't get the difference. But state money or government money for somebody that has a sovereign currency is what the So reserves, dollar reserves held by the central bank, and then of course cash, and you can really classify bonds into that too, as I'll probably talk about later, and of course coin, but that's not that important. And then banks kind of piggyback on that, and they give credit, which creates deposits, but they're not actually. So obviously it's not the loanable funds model. So they're not actually taking in dollars and then lending them. They're just creating promises to pay that are denominated in real dollars. Actually, all you have is bank credit. And so when you interact with another bank, you're just moving bank credit from one bank to another. And then you can call in your promises to pay also in real dollars, like when you pay taxes or buy bonds, the bank will actually have to use its reserves, but you're not doing it. You're having your bank do it as it draws down in your credit account. And the same as you would if you would draw cash as well.
What led you to want to start with that, with the horizontal system? The horizontal system being, as you say, a bank credit. One way to say it is that the commercial bank, as an agent of government, is loaning that money into existence. But another way to say it is that it's leveraging reserves, a government-created bank credit at the central bank. But anyway, why would you start with the horizontal system?
I really think it's important to understand what the two systems do and how they help us in different ways. And I'll probably get back to that. As far as that was a big choice, and in retrospect, it's caused a lot of problems. There's several reasons. It was almost a toss-up. Most MMT people would probably have preferred, and it would have gone a lot smoother with MMT people, had I just started with vertical money. The state, Mosler's story, the state imposes a liability, then spends the tokens of that liability into an economy, and only then can it tax them out. And then later, banks or private entities, well, really, as Moser always highlights, some banks are publicly licensed. So really, it's almost not even, it's also a type of public money in a way. So that would have been an easier story. But several reasons I didn't do that. One, it was just, I was writing and one of them had to go first. So it was just almost like a flip of the coin. I started with private to see how it would go. But the other thing was several reasons. One, if you already believe vertical money or state money comes first, you probably are already sympathetic to MMT. And what I wanted this book to do was to start out in a way that for people who were either hostile or just didn't know anything about MMT, that would be comfortable for them. So I was aiming it for like businessmen who haven't really ever focused on MMT, or students who've just had a macro 101 course, or even high school students. As you know, the important thing is to get the people who don't understand or don't know about or are hostile to MMT to come on board. We need more people to understand it and vote differently and so on. So part of it was who I was targeted at. So I wanted to start with something they were familiar with. Part of it was at that moment, I was kind of thinking of the development of modern states, which really in their form now stems from kind of the 1500s and the rise of the private banks in like Northern Italy. At that point, you didn't really have quite yet modern nation states. That would happen a little bit later. You have proto-states in Europe that were borrowing pre-existing private currencies from banks to fight wars and things like that. So I was kind of thinking of that as my starting point. Other people, and later, for example, in Graeber's work, where he goes all the way back to 3500 BC, and he starts with state money with Sumerian taxes and all of that. So later I tried to kind of address those issues in some blog posts I think I mentioned to you. So those are some of the reasons. So I did start with private money. And unfortunately, I wasn't really focused. For example, I love Graeber's work on the stuff he's written about how coins were during periods of war, but state money and credit money were, different time periods over the last 5,000 years. But I hadn't really focused on his barter argument. I kind of just started out with the normal story with commodity money. And also a lot of people instinctively don't like that. I know, Christian, you've mentioned it quite a few times. So later I'll explain why I did that and clarify a few points on that.
With commodity money, I know that you don't agree maybe with the rhetoric of David Graeber when he talks about the myth of barter and stuff. Could you say what your position is on that?
One, I want to point out this is when he was still alive. It was a bit snarky. I didn't mean for it to be. It's just, when you're writing with a little bit of passion and, I put it out there. Later, we went back and forth on that a little bit. I think I mentioned to you, it was right during the MMT conference in Adelaide, so I was a bit distracted texting with David Graeber. So basically, what I tried to clarify, the first post was quite long, and you know how it is, the second and third post, I was able to distill my thoughts more. But basically, I have a problem with the whole, it's true that mainstream economists use a stupidly simple barter story. And that I completely agree with Graeber that they've got that wrong. But at the same time, his whole point, he keeps making the point that barter economies never existed. But that's actually precisely what the barter story says. And it says it in too succinct a way. But the barter story is about the fact that a very small group, tribe, band of people never could grow into larger, more complex kingdoms or states or any kind of larger society with barter. And that's exactly what the barter story says, that no, they couldn't do that, so that they would have come up with something money-like first, then they could expand. And of course, later, as he points out, the earliest historical record, we already have basically state money in Sumer in 3500 BC. But there had to have been a point before that where you have to have some kind of unit of account that's agreed upon. As I mentioned in one of the later articles, it's just not possible to impose liabilities formal liabilities if you don't have already formal assets. If I say you owe me 10, I have to know 10 what? It's unlikely that all of a sudden in 3500 BC, they just came up with the word shekel and gave it a value. There's good historical and archaeological evidence to suggest that intergroup trade developed, and that did lead to standardized measures. When I talk about standardized measures, for example, the very article that Graeber quotes from Carolyn Humphrey that people quote all the time, and he leans on it a lot. If you look closely at that article, you actually see modern examples in that article. Her main case study is the Lomi of Nepal, and they actually trade salt in exactly the way the commodity money story says, and it's not from having money before. It's their traditional means of exchange throughout Nepal and Tibet.
That is two different tribes. Like within the tribe, they don't use it, but when it comes to communicating with an out group, that's when they use it. That's what I got from reading into that.
Yeah.
I mean, is that not arguably to governments, like Keynes says, governments or ancient authorities deciding on what the unit of account's going to be? It could be gold, it could be salt, but the point is, whatever the authority is in that time and place decides what it's going to be.
If you look, it's a very slow process, and stopping at 3500 BC is too early. You've literally got 5, 10, or even 20,000 years of intergroup exchange. Now, it's true that the barter story as told by mainstream economists, of course, they get everything wrong, so I'm not surprised they get this wrong too. I agree completely with Graeber that within small groups, especially earlier times, or even to modern day, in-group relations are indeed likely to be based on group production, group identity, kinship, redistribution, gifts, spheres of exchange, status, reciprocity, all of those things. So it's true, and he does mention this, I think, that it's intergroup. And Polanyi actually mentions that a lot too. So it's true that you have to change the story a bit, but all of those things I just said, redistribution and reciprocity and spheres of exchange and all that, applied within groups, but it probably did not apply to outgroups. So they actually would be a more market-like exchange with groups that you don't know or trust well.
So are you saying that when the authority created a currency, they basically picked something that was already familiar to the tribe? Measurements
developed, as we know, all over the world in different ways, but they would have been based on really old stuff like how much barley does a worker need a day, or how much barley does a worker need a month. We know in parts of the ancient Near East, that was what they were doing. It can be other things, obviously, like handfuls, or the distance you can walk for distances. All the measures developed from very old local cultural things that would have developed over hundreds or thousands of years. And it's far more likely, when we know about how measures in general developed, that long before 3500 BC, there would have been accepted. It could have been standardized pots, standardized baskets, weights, volumes, whatever. And those would have had names, and those probably would have already been spoken about as units. And then as you start getting centralized states, then they're going to obviously use measures that are already established within their culture.
I don't know if this is comparable, so correct me if I'm wrong. So we have this story back in kind of pre-colonial Peru, where we talk about how taxes worked before the Spanish came. They say that it's usually the authority kind of tax, and this was an empire, so they were expanding all the time into other communities. They basically taxed the local population as in a month's worth of agricultural produce. You had to basically work for the government once a month out of the year, and then you were free to do whatever you wanted. So I don't know, we don't know how that would have been measured. They have maybe requested something like they had means of conserving food for very long times. So I know it sounds bizarre, but could it be possible that they used things like potatoes, like the same way that these tribes might use salt as a means of exchange for a while?
Yeah, I think so. I focused on the Near East because a lot of Eurasian and European developments that dominated the world eventually trace back to those. But it's famous that cacao was used as a means of exchange in Mexico, so that would be very similar. And the main thing is that you have some kind of thing that is valued, usually for the real value, at least at first. Later it can become symbolic on its way to becoming even more symbolic with a representation of it as a coin or whatever. You have these things that have value, and the important thing is that you establish equivalences, and that's exactly what happened with the lomi, with the salt trade in Nepal. So you're able to say X amount of this good, whatever it is, so salt, that you would say, okay, the equivalences, so this is worth 10 of these, I could buy this much salt or this much meat. And that's obviously how the commodity money kind of smooths commerce.
Yeah, because my view is they might have had an expectation of what a month's worth of agricultural produce looks like.
Yeah, and the Near East, they had specific measures of grain, I think, that they knew were like the basic rations for a worker for a month.
Clint, how do you think this all sits with Randy Ray's assertion? I like the way he says it, where he goes, we can only speculate about the origins of money because nobody sat down and wrote, today I invented money and here's how I did it. And he goes on to say, like, the earliest writings, as far as we can tell, are accounts of people marking down who owes what to who. And he jokes that writing wasn't invented by poets, it was invented by accountants. and that was, that became, that those ledger systems became early money. And he also says, out of all the speculating that he's seen, the thing that he finds most persuasive is from another scholar who speculated that it came out of the Vergelt tradition. So, you have one person injuring another person, and, in order to do justice, you're going to have to do the same thing to the other person, and it might be that they put the other guy's eye out, and it's like, okay, an eye for an eye is going to leave us all blind. We'll have to figure out a way to pay a debt like that in not an eye. Let's figure out some unit, and that anyway. That, as far as I can tell, that's Randy's take on why people started measuring this thing that we call debt or money in units. Rather than they all mutually agreed that salt was valuable, and now we're going to measure it in bags of salt or bags of grain. What do you say to that?
Well, I certainly agree that Vergeld would be a form of like a tax or something like that. So obviously from taxes, fines, fees, scutage, all these different Vergeld, anything that the state makes you pay. Basically, my point is that Graeber goes back to 3,500 because it's the oldest historical record, and we already have a pre-existing vertical money, basically. And you also have a very centralized state, which you wouldn't see states that centralized again until classical times and then after the Middle Ages. So there's only a few times that states generally develop that centralized, and those are even more centralized in a way than many modern states were. So you go back to 3,500 BC, but I'm not talking 5,000 years ago. I'm talking 10 and 15 and 20,000 years ago. It would have been an extremely slow process that weights and measures or agreed upon among tribes that are slowly growing in population, slowly transport costs are decreasing, and productivity is slowly increasing. So they're coming into more and more contact with each other as you go from 30,000 years ago, 20,000 years ago, 10,000 years ago. So you have this incredibly slow development of cultural measures that eventually get co-opted as an agreed upon, at least regionally, unit of account. And that's basically what the barter story says happened. It just says it way too, as if people were bartering 200 years ago, which they weren't. If you look at it really long term, the development of commodity money fits in just fine with MMT. There's no problem there. I don't agree with the idea that talking about commodity money is somehow straight away leads you to neoclassical economics or something like that. Certainly neoclassical economics tries to act like money is just a veil over the real economy, which we know it's not. But I just wanted to get the history straight on that.
But we are still saying, kind of what Randy Ray says, that prehistory, if you like, that you were talking about, like 10,000, 25,000 years, it is still speculation, isn't it?
Writing was basically invented at the same time. It started, we have records to 3,500 BC, which is why Graeber focuses on that. And that long predates Werdigeld, probably, or unless they had other similar systems. So you would have had lots of different demands by any centralized power, more than just Werdigeld. So one of my focuses, I worked with Denise Schmatt-Besserat, which is she's considered, I posted you a link, kind of the discoverer of the first writing. And she worked with the tokens that were found all the way out throughout the Middle East that now she dates back, some of them to 9,000 years ago. And I don't know if you're familiar with that story, but so these tokens that were found all over and they didn't know what they mean. And later she figured out that they represented quantities of agricultural goods. And what they would do, it was kind of like a really early version of Bitcoin that wasn't hackable. They would make about the size of a softball or melon, a clay envelope, and they would put inside the tokens, if they were transporting, say, to another region or something, tokens, and then seal it, and it would dry. And then before it dried, when it was still wet, they would press the number of those tokens on the outside. So if they were delivering something or trading something, you had these sealed clay envelopes with what was marked as now it's dry, so you can't really change it. And the only way to check it, you could break it open, and then those tokens would be inside. So it was a tamper-proof system for transferring. And little by little, rather than pressing the tokens into the wet clay, they started using some kind of instrument to scrape it into the clay, and that became cuneiform writing. And so basically the first writing and the first accounting was the same thing. And we know that goes back, there's tokens back to 9,000 years ago, which is many millennium before 3,500 BC. So we know that they were trading and basically writing and accounting thousands of years before Sumer. And so from that, you can kind of extrapolate the development of money of whatever type, and credit and vertical money. It certainly was probably a slow development of standardized measures. Sometimes the measures were easily standardized, obviously 1 sheep or 1 cow, and with grain it would be a basket, a certain size basket or whatever of grain marked on the outside of these clay tablets.
That all makes sense to me. I'm thinking about colonialism and how it happened, because that's an era where all these kind of currencies started kind of being imposed all over the world, I guess. And in Peru, it happened that the colonialists basically would demand a quantity of silver. That was one of the ways they would tax, but it was one-off, many ways. To what extent is it necessary that it has to be something that was pre-existing? And to what extent can it just simply be, the whatever requirements that authority or that external oppressing government wanted to supply for itself?
So, I'm talking about the very earliest stages are relatively less complex societies where they'd still be using commodity money. It would rapidly, like I said, get co-opted by a central power. And if they were taxing, then it becomes a tax credit. So I'm only saying the origins of units of account. If you look into it and you keep going back and back and back, it always has at some point a real measure that gets later either changed or you get a token that symbolizes that measure, and then later it gets lost in the mist of time. You can also see that in more recent history. You were talking about silver in colonial times, and also about intergroup trade in the kind of the age of exploration and all of that. After that, when the Spanish were all over the world, the Spanish silver coin became the kind of world trade. It was accepted all across Asia and highly desired. Silver was highly desired in Asia at that time. It was really Europe's kind of only export to Asia. They didn't want anything else from Europe. And later in the United States, and the United States dollar was based after measurements of the Spanish piece of 8, the silver in it. And so it's just a baseline. What really matters, if you have a brand new currency, you have to base it on something at first, that either a previous currency or something that has a known value. And then once the structure of liabilities gets built on that, you can completely ignore the original measure, especially free-floating currencies. So, for example, the euro is a good example in that the blog post I have on that. I use it because we have 3 decades or 4 decades of history of how it developed. But the same thing would have happened with other currencies many times throughout history in different permutations. But the euro was based on a fixed rate before they actually transferred to the euro. And they were able to transfer overnight, basically, because there was already a system of liabilities and banks tax owed and everything throughout the EU, although denominated in different currencies. But before that, they said that way before they actually changed it, they made it the ECU, the EC, the European Currency Unit, which before that was based on the EUA, I think it was called, something they started in, I think, the 80s or 70s even. And before that, that was based on special drawing rights, XDRs. And the XDR before was originally based on $1 and a quantity of gold to start with.
Yeah, but that's because the US was on the gold standard.
Right. Yes, I agree. But you have to, even if it wouldn't have been on the gold standard, the XDR, if you made it 1-to-1, which at that time when they first did it, it was, you were still based on the dollar, and then you can trace the dollar back, and you can trace the dollar all the way back to a unit of silver. So the origins of a currency will always have to be some kind of already accepted measure.
Yeah, I hate to push back on it, but if you go back far enough, with our currency, you could go, oh yeah, it was based on gold, but then you go back before that and there's tally sticks and it's basically whatever the authority says. Yeah, it might have some intrinsic value, but
yeah, but what are they tallying?
Oh yeah, real things. But the point is they're using symbols of the real things, IOUs of the real things.
I mean, I completely agree. Credit and vertical money both become, once you start taxing, or else it just becomes debt. Once you get the unit, then it can float away from, and it took people a long time to understand that. Coins throughout most of history probably weren't really valued because of the precious metals in them. It was just a stamp on them. So they were already in a way a tax credit or a symbol.
I imagine you'll probably say this is a commodity. But, when Warren and I think Stephanie also in the Deficit Myth talk about the hot tax, British colonials, they would impose a tax on a sort of non-monetized society and say you need to pay us these tokens or face penalties, we'll burn your hut down or whatever, the hut tax. And it wasn't a pre-existing unit. They said, these are the coins you need to pay us. We create them.
But they did give a kind of a real world value to them, your house.
But more accurately, the way they actually assigned the real value to them is by saying what you had to do to get it. If you work for us for a day, you get one.
Yes, the imposition of liabilities from the monopoly in force is absolutely central, of course, to vertical money. But I was just looking at some historical cases. But anyway, the only thing I wanted to point out, I didn't really mean to get into all that history, but after I realized that people didn't like that I included anything about that basic story in the book, I ended up writing the blog post to clarify some points. There's 3 or 4, I think, that relate to that.
How would you tell the story if you were going to start with vertical money?
Well, yeah, that's easy. If you the imposition of taxes, the hut tax was a great example. But in general, for example, again, back to Graeber 3,500 years ago, because that's so old, I think the shekel was already being used, the measurement. And there's evidence so that originated from some kind of measure of grain at first. But if you're willing to start that there is an accepted unit of account and whatever it is, or else if you make one up, then you just start with vertical money, the state imposing a liability then spending that token into the economy, and the people know that they owe 100 of those at the end of the year or whatever. So they're going to do public work for them. So and then you build the banking system builds out from that, using that measurement as its denominator.
When you dive into Bill Mitchell and Randy Ray and Martin Watts' textbook, it's a government-centered approach. It's, macroeconomics starts with the government, and the private sector is, like you say, responds to that. If the money story starts with the government, then if they've decided to overtax or underspend, it's on the government, and we literally do build unemployment into our economic plan. It helps the case for moving towards more progressive economic policies, because then you're going, it's on the government. With all the good intentions in the world to provision the public sector, they've started this system, and that they're just mishandling it. Just right at the end there, they're leaving too little spending power in the economy. And therefore, it's on the government to do something like an employer of last resort or something. Otherwise, you're just damaging people. If you start with the horizontal money, with the, money sprang up through mutual agreement and people making exchanges, you are going to come to the conclusion that the government's interfered with a thing that was happening organically between humans. And therefore, unemployment, could be a choice of a lazy person, rather than it resting squarely on the shoulders of the government, the issuer of currency.
Well, I was going to say, it doesn't matter in a way how you start. When you end up, for whatever reason, however historical reasons, with a country that wants public goods and taxes, that they don't want taxes made the people, but they tax, and the people want public goods, you're going to end up with MMT. I mentioned, for example, from the Middle Ages, you do have a case where there were pre-existing giant banks in northern Italy and other parts of Europe that proto-states that weren't able to tax yet did borrow from, and that's important when we understand. It's part of the reason we have a bad understanding of bonds to this day. I'll mention that a bit later. But MMT is correct anytime you have a taxing state and a desire for public goods, including a job guarantee. So it doesn't matter how it originates. I mentioned that it could have gone either way, and actually they start with vertical. Regardless of what you start with, you're going to end up, if you have public goods and taxes, with an MMT system. And then it's just a matter of what the public wants as for public projects. Obviously, you want to have public projects up to the point of all desired real resources. And then you might even take from the private sector if the public so decides, even if that is using actually not just slack in the economy, but you might actually take, reduce some private activity and move it to the public sphere.
So you had mentioned offline that you would have liked to have included in your section about the job guarantee in your book, you would have liked to have included universal basic resources. Could you talk about that?
Well, it can be really brief. I focused on the job guarantee as one of the things. I completely agree, as you can see in Chapter 3. The universal basic resources, it also comes down to some other points later, but one, it's just an obvious welfare, well-being thing that would make sense from the point of view, rather than just giving people money, although there's times when you should do that too. If you have all the needs, we already recognize some basic needs, but expand that sphere to include communication. So maybe, a national internet that's free for everybody, because it's basically necessary to live these days to do so many things. Of course, transport, housing, consider those basic needs that we, resources. We already do that with libraries. And so just expand that. And then on top of that, the other effect from that we can talk about several times, like Kelton mentions a lot, but it's the crowding in effect. So obviously, if you're a business and you can move your business somewhere where all the resources are there for your workers, including healthcare as well. It's crazy that in the United States, we still link healthcare to employment. I mean, companies would love it if they could just shed the entire health aspect of hiring somebody. So it makes no sense. So you would also, this investment in infrastructure and all of that, you actually create the crowding in effect where you're going to make a more favorable business climate as well as raising well-being at the same time.
Yeah, that makes a lot of sense to me. I think China probably has followed a strategy like that of providing resources at local level and letting companies basically benefit from that.
Yeah, and of course, Northern Europe to a great extent as well.
Mm-hmm. With regards to your article about the decoupling spending from bonds bond sales. I very much enjoyed that article, actually. I was wondering whether you could lay out the arguments that you made. Why are bond sales currently made, and why do you think they're not needed?
Yeah, I probably would have written that a little different. I happened to be reading right then Richard Murphy, and he's really worried about savings vehicles and pensions. I was reading that really literally at the moment I wrote that, and I focused more on that than I wish I would have, because later, as a matter of fact, Steve Hell and I don't remember his first name, Joy, the last name, they wrote for the Global Institute for Sustainable Prosperity last year another article similar, just get rid of bonds. Obviously, that would mean zero interest rates, probably, unless we use interest on reserves. So in general, I wouldn't even defend bonds like I did in that article. I thought that was a bit distracting, but I'm glad you enjoyed it. Basically, I just point out the reasons I think we know from MMT accounting, bonds really don't do anything except, as you focused on before, Christian, pay wealthy savers to save. So that just exacerbates inequality. So there's really not, and we know interest rate manipulation isn't useful in the way mainstream thinks it is. And this kind of brings me to a point that I wanted to focus on, that MMT economists, I think, generally haven't proposed too strongly, besides maybe Hell's last article, but Kelton and them, that to get rid of bonds. And they're correct in the sense they understand accounting so well that they know that I don't know if you've ever read the article by Peter Cooper in Head Economist, where he describes Scott Fulwiler's earlier article and the way that bonds don't actually add money to the economy. They take out reserves, and the person who had reserves just ends up with a different color reserve, basically, that gets a little bit of interest. So as we know, and of course the MMT economists understood that so intuitively that they haven't really worried about changing the system. And when you ask about getting rid of bonds, they say it's not worth the political capital to do that, because really bonds don't matter if you understand the accounting. And that's perfectly true. I've always emphasized, though, and I've seen a few MMT economists do the same, I believe that in the real world, the people elect representatives who do the spending. And as we know now, it's kind of the point of my book, they don't spend, and this you were saying, Christian, something similar, they don't spend on public goods in the way they could, because they have this fear of debt and all that, or at least their constituents do. So, but if you've looked into the detailed accounting of the British system or the American system or whatever, it is very complicated very quickly, trying to understand, repos and the role of the Treasury and the role of the Fed in all of the way money gets spent, issuing bonds and transferring it to a Fed account and all of that. And really, a lot of mainstream economists don't even understand the accounting of that. And certainly the public doesn't. So I do think it's worth the political capital to get rid of bonds completely and just have one token from the government that we're allowed to save in. We're kind of moving that way if we got CBDC, or it could be in the Treasury, it could be in the Fed, it doesn't matter. But I mentioned in the book to allow us to save just like we could with bonds 100% safely with the Fed or the Treasury, just like we do with bonds. But they make a big deal out of it, but it already exists. It's just the accounting at the reserve. Obviously, some people want to make it more private. That's, I think, the focus of Ron Gray and some people like that, to make it encrypted in a way that it's really like cash. In other words, you can still have totally private transactions. But if we allowed just accounts, and it's totally doable, post office banking, you could have another reason, have post offices in small towns, just have, instead of having bonds on record at the Fed, you would have your savings there. It would be 100% safe. And they probably wouldn't earn interest. You'd have to invest for that. And we could just do away with bonds. And we might sell bonds for some other purposes, maybe, if we wanted to give some people interest for certain reasons. But, like I said, decouple it from any idea of it has to do with spending. And the political gain from that is we would get rid of the word debt. And, some people, maybe you have said that, we wouldn't have anything you could call debt. There'd be a number sitting in the Fed that corresponds to untaxed reserves that are in the banks and whatnot, are held by the people in this case as well. But, you wouldn't call it a debt. It's just the opposite of the amount that's out in the public.
Okay, yeah, no, I'm all for that, like you say, the severing the link thing. And, in a way, Rowan's idea, the mint the coin thing, again, I think is an attempt at severing that link. Instead of the government having to quote unquote borrow money, we're just going to create that stuff out of thin air, and we're going to embody it in this platinum coin. and say it's $1 trillion and pay it into the Treasury's account at the Fed, and then the Fed have $1 trillion, and then we make two of them, and then they have $2 trillion. And anybody that's kind of wondering about whether sovereign governments can create their own money gets an answer to it, and then the people who kind of already know the answer and go, we can do this already without the coins, then you go, okay, so do it.
Yeah, the key is that the public doesn't understand, so they don't vote for people.
Yeah.
So basically, the United States has already done that. When the Treasury used to issue U.S. notes, they were from the Treasury direct. They were basically just literally pieces. They look exactly like $1 today, but they were from the Treasury. It says so. They have a slightly different color stamp on them, and red instead of green, I think, or green instead of red. They were just bonds in paper form that were perpetual with zero interest, and they still exist. $5 U.S. notes still float around sometimes. So it's the exact same accounting as the platinum coin, which is also coins are from the Treasury. Most MMT people seem to want to keep the Fed and have them spend the token in. It doesn't matter really, though. I would rather see the Fed folded into the Treasury and just have the equivalent of U.S. notes in the past and get rid of bonds. But it doesn't matter as long as it's from the government who has the accounting sheet on their computer.
Out of curiosity, just how would you do that exactly? The folding in the Fed into the Treasury or any central bank? As
I think Mosley or somebody said, really the Fed is just a spreadsheet. That's all it is. And we've given them, stupidly, in 1951 in the States, and, all the so-called independence, which, as you've mentioned, Christian, you've made fun of, we moved it up 0.01% the rate or something, as if that does anything useful. So their quote-unquote independence is useless, really, or even harmful. So just fold them in. It's just a spreadsheet with the accounting of the spending of the government. Like I said, the U.S. notes before came directly from the Treasury. That wasn't a problem. We would just put it all in there and get rid of the MPC in England and the FOMC in the United States and replace them with real resource economists. So this ties into the Rohan Gray, and there were two other co-authors, I can't remember, Financial Times article on inflation, where Kelton and Gray have said, look, MMT isn't just saying to tax, because everyone says that's too hard to get going politically if there's inflation after the fact. Although sometimes you might do that, but to think before you spend how it's going to affect different sectors and different aspects of the economy. So, educated people on real resources in different sectors of the economy and the real economy. And so you kind of replace the MPC or FOMC here with economists who actually do something useful, which is study the real economy and advise Congress on, do $300 million in that because that sector's got a lot of slack, or be careful in this sector because the housing sector is already red hot. And if you spend more on, thinking about the real economy. So this all kind of goes together. Get rid of bonds, merge the Fed Fed independence is useless, and get some real economists in there that actually do something that helps with inflation and understanding the real economy and well-being.
Just before we move on, I was just going to pull this quote from the book because it kind of caps off what we're talking about, and I think it really goes to the heart of MMT. I've changed it slightly, but this is very close to a quote. As we know, public projects are the democratic transfer of private resources to desired public projects. On the island, the public and the representatives they choose to guide their money system know that the cost of these projects and the ability to carry them out is measured in real resources. The quote-unquote funding of these projects occurs the moment they vote to do the project. That is, the moment they make the decision to put their real resources towards something. They fund a road when they decide together to build it, not with abstract numbers in a ledger that they themselves create. The ledger entries are merely an organizing tool, which I think that's a great paragraph, and it just really it's everything we've been talking about there. That governments or issuers of currency should be thinking about these things and what does it cost in terms of resources. Like you say, the numbers are a residual.
Really, that's the main focus of my book in a way, is trying to get people to realize that there are they run very different. The banking system and the government system, but they're totally unified. The public doesn't see, you don't think differently if you transfer $20 from your credit in your bank or give somebody a $20 bill or whatever. It's just organizing tools for the private sector from banks who judge creditworthy projects and then fund them with credit, and the public who just creates when they spend, it creates dollars. I said it differently on another podcast, and he really liked it. The funding is when the hammer hits the gavel, and that's funded. And then the units that you need to organize that, they're, as we know, like points on a scoreboard at a football game. And that's just the only purpose for that system. And the reason we tax is to keep that system viable, is that it allows the government to, as Moses always said, provision itself. Economics is a science of social provisioning, really.
Oh, I like that. I like the way you just said it. Economics is a science of social provisioning.
Yeah, that's a common post-Keynesian way, I think, as opposed to with scarcity and all that the mainstream uses.
So there's a part towards the end of 1000 Castaways about international trade, which I found interesting and concise. And you reference Eric Reinert.
Yeah, Eric Reinert is a heterodox economist. He's actually, I think, worked closely with John Kregel, which has actually been, close to a lot of MMT people, I think. Their school, they kind of call themselves the other canon. That's one, they have a website like that has some stuff, some papers. And Reinert's work is just excellent. He has 5 or 6 papers or chapters and books that really talk about how trade has been. Mosley, for example, is famous, and of course other MMT people, for saying that it's great that we send dollars abroad and get things back. And like I said, I point out in the book, under a neoclassical paradigm, that's true. When X equals X dollars, it doesn't matter what is being sold and bought. But what Reinert is, I think that's a little bit too simplistic, and it's not a critique from a neoclassical view, it's a heterodox view as well. But what he points out is that over hundreds of years, even when they didn't realize it, and under mercantilism, for example, the economies who have developed have always been the ones who understood, either intuitively or sometimes actually understood it, that you need to export higher tech, increasing returns industries type stuff, and import primary goods, and your economy will most likely develop. And if you do the opposite, like try to export primary goods and import, which are usually decreasing returns, and for high tech goods, you are going to not develop. And that's really the heart of mercantilism. A lot of people confuse mercantilism with bullionism, which is the focus on hoarding gold. And there's other aspects too, I think, that are important to the argument that importing goods is good for the economy. I don't think it takes into account enough externalities. And the key ones are, just as the resources themselves are real, I would define a varied economy as a real resource and production as a real resource. And you lose that when you start allowing other countries to make your high-tech goods. So you diminish the complexity of your economy, you diminish the varied job opportunities, which is good for the people. And, there's all kinds of people who want to do all kinds of different things. And a lot of people would like to do things that are more involved with higher tech rather than working with primary goods. And production, we've seen that during the coronavirus with the supply chains and all that. So another reason you want a varied economy is, Jane Jacobs focused on this a lot, you're likely to get more innovation if you have all different kinds of industries at all different levels working close together. And basically, increasing and decreasing returns lead you to realize why agglomeration happens, like Silicon Valley or like Manchester in the Industrial Revolution, or Detroit with cars, or it's happened over history many times. You tend to get, with increasing returns and technical, whatever it's technical for that time, industries are going to tend to agglomerate, at least for some time. And if you are buying those from abroad, you're helping them agglomerate out of your country. And what you want is the opposite. Like it or not, every country that's ever developed has been on the leading edge of technology and industry, which also, I'm not being pro-military, but also, it does also, you tend, if you're industrial and have high tech, you're also going to be less vulnerable militarily. And I'd like to point out, even Mosler in 7 Deadliness of Frauds, he kind of recognizes this with steel. The one thing he says is we should keep steel in the United States for kind of strategic reasons. I would just say that same concept applies to far broader things than just steel.
To be fair, he mentions steel as an example of strategic resources, things that you don't want to lose control of. He doesn't go into a deeper explanation of, and also high tech for the military and he just sort of says strategic resources. So
it might be good to ask him about that? Because I know we've spoken to him about it, but maybe specifically about what Clint said about the variety of your economy being an asset in and of itself.
There is this idea that, you don't get to develop that high-tech sector. Let's say everybody in America is mining coal, and if they don't realize that if they can import coal, and that's actually a benefit to the economy, then they don't get to go into higher tech stuff, which kind of agrees with what Clint was saying about, you need to stratify resources into high value and low value. But do you see what I mean? I think that's kind of where the imports are a benefit, exports are a cost thing goes to.
No, that doesn't deny that statement at all, I don't think. I think the inputs are a benefit is pretty clear. I think it's just about what strategy do you want to follow in your economy, and in what place does tariffs and potentially subsidies have to do in that strategy? Because when you protect an industry with tariffs, what you're effectively doing is you're raising the price of that good in order to make it easier for the local industry to develop. So in a way, it does represent some cost.
There is a strategic value, as you said, but I think more emphasis needs to be put on, yes, there is a cost for tariffs. I'm not necessarily, I'm not saying there's not, but we need to put more value on the varied high-tech jobs that people want, and which is really important for, people in general, and more importance on the being somewhat self-sufficient in your production, both for the ability to innovate more and, of course, security and other things somewhat related to that. The Reinert stuff is especially good to read. I have a list of the key works in the back of the book. James Galbraith has written similar about free trade, and he even mentions with comparative advantage relies on this assumption of constant returns, which is not generally the case. And nations trapped into specializing in agriculture are condemned to perpetual poverty, as agriculture is dependent on land, a finite, non-increasing resource. And you get some stuff from John Harvey as well about decreasing costs, which describes the situation in many developing nations find themselves in. All they can export are primary goods, while developed nations can export manufactured technological ones. And he goes back to the old Portugal-England thing about free trade from Ricardo. England finds itself at an increasing economic and no doubt political disadvantage to Portugal. So basically, both Harvey and also Armstrong and Khalim Sadiq, in their writing on capital controls, they touch on some of these issues as well. From different angles, you can see why being somewhat self-sufficient in high-tech stuff is important for developing your economy.
In the book, your rules for making commercial banking functional for everyone, which build on Warren Mosler's proposals, they're very clear. Would it be okay to run through them?
So these are really just more or less straight from him. I didn't change them much. The main things about keeping the horizontal in check in the real world, as opposed to the relatively simple island economy, is the first. This is just not, you license the banks to do some things rather than just licensing them, and they can't do anything else, and they have to come and ask if they want to do something else. So this is all about getting back to plain vanilla banking of the 50s, which, as we know, we had an economic boom in the 50s. So it's not like the banking didn't work then. And then the rules that he specifically lays out, they're so simple, but so obviously would be useful. The first one is that banks must keep the loans that they make on their own books until they clear. And the reason this is so important is that it will force banks to really do good creditworthy analysis, which is their primary purpose. And again, all of this is about simplifying, which is good for transparency as well. Banks can only lend directly to borrowers and for capital development purposes. Banks should not be allowed to do anything besides basic banking. So they shouldn't have, nowadays, banks in America are doing all kinds of other things. And related to that, banks should operate on a single balance sheet with no subsidiaries. So this serves to make it, much more transparent. You can open the book. It's all on one balance sheet. It's all loans that they've originated. And so, really quickly, an auditor could see the health of the bank or what's going on. And finally, no financial collateral. That just leads to instability and debt deflation in a long time, as we've seen. And the last is they shouldn't be able to sell or buy credit default insurance, because that ruins the incentive to only do credit analysis. And so in other words, if they somebody defaults, the lender, the bank should lose the money.
Yeah, you shouldn't be able to bet that someone's going to default.
Yeah.
And then extend a bad loan to them.
And those are all would be so easy to implement, but yet would be extremely powerful together to stop a lot of what happened in 2007.
Can we just pause on banks cannot accept or should not accept financial assets as collateral? Could you give us an example of a type of financial asset we're talking about?
Yeah, I'm not an expert on that, but obviously, like we had this also goes to complexity as well. There's no reason. I think I mentioned in my book, anybody who says, oh, you can't regulate because it's all too complex, they have something to gain from it. Like the what were they called, CDCs or whatever, the really complex, like the stuff in, what was it, was it in The Big Short, the movie, or
the one where they put the mortgages inside one package and then inside another package?
Yeah, that's even more complex. And then there's more basic stuff, but just basically, like it says, it's just a financial asset, can't be used as collateral. So it has to be, if I, give you a loan for a business or a house or whatever, there's some real resources involved. Whereas if I just give you a loan based on something else that might be kind of a phantasmic, lending with finance as collateral just becomes a pyramid scheme or a Minsky moment eventually or whatever.
You're piling debt on debt, basically. That's what you're doing.
Yeah, or at least non-real resource-oriented things and non-productive things. It doesn't serve public purpose, as Mosler would say.
And like you say, by bringing up Minsky, you get to the true Ponzi lending at that point.
Yeah, right. It's just going to snowball. And once again, the other rule, not allowing banks to do anything more than what you license them for, that would help stop that as well.
On the topic of regulation, you write that breaking up natural monopolies in businesses that are inherently about networks, communications, transport, is generally not possible. The only way to serve society in those industries is through government ownership or regulation. And I think that's a really important point. Could you say more?
What we should have is public, obviously, well-being enhancing things like education and all that. So, 911 call service and libraries and pure research. And so I discuss that in the book. But one thing that even some people that are pro-MMT don't realize, are pro-public goods anyways, don't realize the reason why they should be public is because you can't split them up. And networks are a good example of that. And there's a lot more networks than people think. Some utilities, we've recognized that for a long time. Privatizing them doesn't work. You're not going to run, the classic example, you're not going to run 4 different companies' pipes into your house and then, choose whichever one's cheapest every month to make them competitive or something. It's hard to be competitive in networked utilities, which is why we usually have national power grids and, plumbing is generally done by the municipality and so on. But this also applies to other things like, for example, the train lines. And I know in the UK in the 90s, you privatized under the, Thatcher type ideas, the train lines, and as far back as the 60s, I don't know if you're familiar with the Beechings cuts, but that was when, way before Thatcher and all that, they thought they were spending too much on the rail system. So I actually wrote down some numbers. In the early 60s, they identified 2,363 stations that constituted 5,000 miles of railway for closure, and 55% of stations and 30% of the route miles that existed then. So, and the reason they did that is they considered the whole system was too expensive and those lines weren't profitable. So these are the smaller lines that go out to the regions and small towns. And what they didn't understand is you can't privatize the profitable routes on any network, whether it's airline or train or whatever, or communications. And then because they're going to only want to serve, and this has happened in England, the primary routes, like from London to Birmingham, I think there's a major line or whatever. So private companies run those, but they cut all the smaller branches. And it doesn't matter whether it's a communication system. Some of the theory on this was developed with faxes and then later the internet. There's something called Metcast Law. The value of a network is proportional to the square of the number of connected users of the system. So yes, that little line that goes to a little village in Scotland or whatever, on its own is not profitable, but all those little branch lines going everywhere. You should be able to get on a train in your small town in Kent and make it to a small town in Scotland. That adds value to the whole system. That's hard to measure. And you can't break that up into profitable and non-profitable bits logically. It's all interconnected. That's why it's a network.
I've always thought that about rail. I had silly rows with people on Facebook going, look, just show me how two train companies can outcompete each other for my money, and that show me how the market mechanisms work in here, because I don't get, shall I get this train to Birmingham or this train to Birmingham from a different company using a different set of rails?
And it's the same with post offices as well. I know you've had some closures, and we have here too, of in small town post offices. One, having postal central, banking with the reserve that then also ran through the post office, which some countries have done, would help keep those alive. But also you just have to recognize the value of a postal system that goes to every small town. You could get mail everywhere in the UK or in the United States, and that makes the whole system more valuable, even though it seems like one remote town is expensive, and it is, but it's worth it.
There's this other thing that defines what a natural monopoly is, and that's where the barriers to entry are so big, only something on the scale of a government, with its capacities for moving resources, can actually enter it. So in a way, I would put a lot of medicine in that category. It's a bit like the Pentagon budget or something. It's huge, and they don't know what's going to work and what research isn't going to work. So they're happy to chuck money at the Pentagon, and
which they never question.
Yeah, exactly. Every 10, 20 years, they come up with a new death ray, and it's like, it's all been worth it. We could take this to where people have got stuff and kill them all.
Careful, Christian. You're starting to sound like a communist. Yeah.
And this also comes back to financialization, which relates, because it, as we've let more things in the United States become privatized and depend on the private financial sector for short-term profit, that has all kinds of well-being effects. But it ties into this public goods in the sense, and big projects is what you were just talking about. It's incredible, the United States, and this also comes back to varied jobs. The United States can't build big ships. Northern Europe and South Korea build all the big ships in the world. I was just reading, they're trying to put in offshore wind turbines, and the United States has 7, I think, right now, and Europe has like 2,000 something. And there's no ships big enough in the United States that can do it. There's finally actually somebody building one here in Texas, actually, but it's way, way behind. And like when my stepfather works in printing, and when they want to buy these massive high-tech printing machines, they all come from either Germany or Japan, because they have the type of foresight to invest in the production of large, expensive things. And the United States has lost to some extent, and is still losing the ability to do that as things like hedge funds and all that just go for financial gain in the industry.
So we've done episodes about hyperinflation, but I really think the aphorism that you came up with really nails it and really helps put it in perspective. And I'm going to quote it now: airplane crashes aren't hyperlandings, which I think is a great way to put it.
One of the main points of that is to emphasize, obviously with images, that they're not the same thing at all. Hyperinflation is not high inflation. It's a currency collapse due to completely other things. So when we talk about inflation of 3 and 4% due to whatever it is, a supply shortage, or although I do have another article where I challenging one to show me where government spending has ever caused problematic inflation in stable countries. But anyways, I don't think there's hardly any cases where government spending causes, but some people say it does. But there's various reasons we get inflation. But when you have hyperinflation, you have a very special case where I linked to another article that's related earlier. This is kind of Geographer's point of view, what's called autocorrelation. I used a Cato Institute working paper, so it's not even skewed towards MMT or anything, quite the opposite. But he tries to list, I think, 57 cases of hyperinflation throughout the world. And when you group them together by countries and time, which I do in that other post, you can see that there's been basically about 7 cases of hyperinflation in the world. And one was post-World War I countries that lost, basically, and all shared similar intellectual and political schisms between Bolshevik and rising fascism, all these various things, reparations, continued war when the Soviet Union, Romania, Poland, a lot of people forget that there were ongoing wars after World War II in the early 20s. So all the cases are just right there. So it's not 6 or 7 cases, it's one case of that whole region just collapsed for all the same reasons. And then the second case is post-World War II, and it's mainly the losers, although it does include the Soviet Union, which technically wasn't a loser, but they also suffered more damage than any other country. And then the other one is the milieu of intellectual thinking coming from the United States, mainly in Central America with IMF and World Bank type loans and everything. So all the stuff that happened in Argentina and Brazil, Latin America, primarily comes from that and some other related causes. But they're all kind of one case, really. They're not And then the last one, there's a bunch of cases that are listed independently, which if you put them all together, it's obvious that it's just the collapse of the Soviet Union. So all the other countries, Kazakhstan, Tajikistan, Georgia, blah, 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 all the Eastern European countries, you can't count those as separate cases. There's one fundamental cause, which was the collapse of the Soviet Union. And all of those different causes for related or similar intermixed reasons will cause the complete collapse of value because you have entities that can no longer effectively tax, and taxes drive currency.
I think you nailed the problem with hyperinflation, or one of the big problems is the word hyperinflation suggests that hyperinflation is inflation that got out of control. And what we're saying here is it's a whole different phenomena. Exactly like you say, airplane crashes they just landed and they did it a bit too much. So it's a hyper landing.
And the way they measure inflation, hyperinflation, so-called, which is a currency collapse, they give these ridiculous, they love giving the big numbers to scare people, just like with the debt, the national so-called debt, trillions of dollars, blah, blah, blah. So they say, it went up 3 trillion% in 1 year, 3 million, whatever, these huge numbers. But that, as I point out, that's like saying, an airplane is flying along and it's hitting little millimeter or, whatever, sometimes a meter or even more, buffeting as it flies, and it's totally normal. That would be the equivalent of kind of inflation in the real economy, kind of go up and down between 1%, 5%, 3%, 8%, even whatever. But that's still just cruising along and is manageable. And then in the airplane, if the engines go out and it's actually flying to the ground, you can put a huge number. I put it in millimeters as well, 17 million millimeters or whatever that number was it's just not the same thing.
Yeah, it didn't hit hyper turbulence.
Yeah, and it didn't decide to hyperland. So the few, like I said, there's really only 7 or 8. Also, you could potentially, after that article was written, put South Korea or Venezuela, but they share the same characteristics. In all of history, there's 7 or 8 so-called hyperinflations, not 58. So one, they're using bad, they're not understanding autocorrelation, and you got to look at underlying causes that unite a region in the world and a time in the world. And then they're trying to measure it on what is inflation, when in fact something completely different happened, where like in Zimbabwe, in that Zimbabwe article I wrote, you can see building really ever since the 1800s with the division of 3 factors. And then ever since the 60s and 70s, one thing after another, after another, after another, led to complete collapse of the government and money systems.
That's something we can do on the individual level, maybe, is something we can take charge of on the communication front, is when somebody goes, well, explain hyperinflation then. Go, well, sorry, don't you mean a currency collapse? I know what you're talking about, but let's call it what it is. I think that might be a useful technique of talking about these things.
And as I point out, there's a special, I do the star analogy, I don't know if you remember that in there. It only happens occasionally in really special circumstances, not just the collapse of a government, but usually you need probably some kind, maybe reparations as well, and some kind of elite that can still force that government to try to survive through adding zeros and zeros and zeros to the currency to try to buy some time. Usually you kind of have all of those in place, because you do have countries collapse that are, like I said, they go out with a whimper, not a bang, and you have that same physical territory and a new government forms, but you never go through the whole hyperinflation. You've got to have all these special conditions happening at once.
One of these episodes actually happened when I was very young in Peru, and you mentioned them in your article about the hyperinflationary episodes in Peru. Do you remember?
I don't specifically remember. I know I talked about Latin America, which is a little bit different than the other cases in the sense, I think the primary driver was the intellectual influence on how to bank and how to run the economy from the kind of Chicago school and all that.
Yeah, but the interesting thing is that I'm actually doing a bit of research on what happened, because I wanted an official narrative, because all I have, is really just memories of being really, really young and things getting out of control, scarcity, just there wasn't anything. So when I was looking for papers, and everything it looks at kind of just the numbers, it just looks at the size of the government deficit and how the deficit financed this, and what policies made the government deficit increase. So basically, they blame it on irresponsible government spending. And I think that's the story for most hyperinflations, like the kind of official story behind it. But I just thought it was really interesting that they just happened to ignore the fact that there were some very real problems at the time in the country, in terms of the country was practically in a civil war at the time. That seems like a very big thing to miss out of this
it's almost always
equation. Yeah, and of course it had a lot of external debt, but they never seem to like they talk about debt, but they kind of mixed in foreign denominated and local debt in the same pot always. So they don't just make a distinction between the two too much. Just everything that you've just said resonated with me.
Thank you. Yeah, in the Zimbabwe article, I really list in detail all of those factors: civil war, international denominated debt, foreign denominated debt, and then I was going to do that for each other country, and then it was just too much, and I was like, you know what? Actually, they all share these same basic factors, so I lumped it all together in the next article. I did include some notes. I started with Hungary for some reason, so I had the most on Hungary. But there's always some combination of civil war, really polarized government. So like after World War I, like I said, you have rising fascist and Bolshevism, you have two extremes, and that just goes back and forth. So you can't get any political agreement on anything. You have reparations going on, obviously, foreign denominated debt, and something, and it's always those things. And like I said, Latin America is a little different. It's much later, and you have the influence of the World Bank and IMF pushing debt as well, foreign denominated debt. But it's always that same combination of things.
So before we say goodbye, what advice would you give to people who are interested in MMT, or what should we be paying attention to or reading next? And, where do you see the potential breakthrough points politically or otherwise?
In 1,000 Castaways, I really tried to just focus on the purpose of the organizational tool of private money and public money and how they work together seamlessly to the public, but they really do two different things in the economy. And then more generally, I just say go back to the basic articles by Ray, Mosler, and Mitchell, because some of the early articles are also easier to understand because they're, hashing out the basics, really. I also found a lot of Scott Fulwiler's work really useful. The headeconomist.com article I mentioned by Peter Cooper, those are excellent for helping people see how public money works. Those would be some of my first things I think I would suggest to people.
I think that's a great place to leave it. It's been great to talk to you. Thanks for coming on the MMT podcast.
Thank you. It's been a pleasure.
That was the MMT podcast with Patricia Pino and Christian Riley. Don't forget, you can support the show through Patreon, starting at $1 a month, and get access to patron-only episodes. You can do that by going to patreon.com/MMT podcast. You can also find me on Twitter at MMT podcast, and you can find Patricia on Twitter at Patricia N. Pino, and you can email us at mmtpodcast@outlook.com. Thanks for listening, and we hope to hear from you.